Do GRM and cap rates still matter? Or have we been running our entire real estate investment strategy on math that belongs in a museum next to a fax machine and a Blockbuster card? Because right now, investors across the country are either swearing by these metrics or quietly abandoning them. And the difference between those two camps could be the difference between generational wealth and a very expensive lesson. Let's back up and talk about what these numbers actually are, because half the people throwing around cap rate at networking events couldn't define it under pressure. The capitalization rate is simply your net operating income divided by the property's value, and the gross rent multiplier is just the purchase price divided by annual gross rent, both designed to give you a fast snapshot of whether a deal is worth a deeper look. Back in the era of 5 and 6% interest rates, we're talking somewhere around 2015 to 2021. A 5% cap rate felt like printing money, and a GRM of 10 felt like stealing. Then rates doubled almost overnight, and suddenly, that same 5% cap rate is a slow bleed because your financing costs have eaten the entire margin and asked for seconds. Here's the irony that nobody puts on their motivational poster. The metrics didn't break, the environment around them did. It's like using a perfectly accurate thermometer in a room where someone secretly changed the definition of what cold means. The tool still works, but the context has completely shifted. The psychological damage this has done to investors is real, and honestly, a little funny if you're not the one living it. People who built their entire identity around "I only buy under a 7 GRM" are now either paralyzed or quietly lowering their standards and hoping nobody notices. What history keeps trying to tell us, through the savings and loan crisis, through 2008, through every rate cycle since the 1980s, is that no single metric survives contact with a radically different cost of capital environment. The investors who came out ahead weren't the ones married to a number. They were the ones who understood what the number was actually measuring and adjusted accordingly. Cap rate, at its core, is really just a proxy for risk-adjusted return relative to your alternatives. And GRM is a blunt first filter, nothing more, nothing less. The mistake isn't using them. The mistake is treating them like commandments handed down from some real estate deity instead of what they are, which is starting points for a conversation. A common misconception worth destroying right now is that a good cap rate is a fixed universal number. It is not, and it never was. A 6 cap in Dallas in 2024 is a completely different animal than a 6 cap in San Francisco in 2019, because market appreciation expectations, local rent growth, and your debt structure change everything underneath that number. So what do you actually do with all of this? You use GRM to quickly disqualify deals that are obviously overpriced. You use cap rate to compare properties on a level playing field. And then, and this is the part people skip you, stress test the deal at higher vacancy, higher expenses, and higher rates before you ever make an offer. The practical lesson from every rate cycle is this: underwrite conservatively, size your position so that being wrong doesn't end you, and never let conviction replace cash flow math. Discipline in how much you buy and at what terms matters exponentially more than being right about a market direction. Here's the philosophical kicker. The investors who are still standing after every downturn weren't the smartest people in the room. They were the most consistent and the most honest with themselves about risk. GRM and cap rate didn't fail them. Over-leverage, ego, and skipping the boring math did. These metrics aren't outdated, they're just misused, over-relied upon, and occasionally weaponized by people trying to justify a bad deal they already fell in love with. Use them as the blunt instruments they were designed to be. Layer in your financing reality, your local market dynamics, and your personal risk tolerance, and they become genuinely powerful again. At the end of the day, the game hasn't changed. As much as the noise around it suggests, find assets that produce income, buy them at a rational price relative to that income, finance them responsibly, and repeat. Whether markets are hot or frozen, that process, executed patiently and consistently, is what compounds over decades. And if you're ready to stop debating metrics and start actually building a portfolio, we can help you get started, whether that's real estate investing, home contracting work, or finding lenders. Check out our links in the description below.